Hello friends, I hope you all are doing well and staying safe at your own place. I, CA Pujin Kapadia, welcome you all on my today's lecture on the subject Financial Management. Friends, today we are going to commence with a very new topic, the name of which is leverage. In this particular chapter, we are going to discuss what is the meaning of leverage, how we are going to use the concept of leverage. There are certain types of leverage, basically classified as operating leverage, financial leverage, and combined leverage. We are going to have a detailed note on each one of them, and at the end, we are going to take certain practical sums on the basis of formula. So this is just an overview. Let's start with the first one, definition. The definition which is written on your screen read as leverage is the employment of an asset or funds for which the firm pays a fixed cost or the fixed return. Basically, this definition says that what is leverage? It is employment. Employment here means you are using something. Fine. Now, what you are using in your business, you are either using the asset or you are using the funds. Now, if I talk about asset, my asset is going to bear a fixed cost, right? For example, I want to purchase an asset. I need to pay a fixed cost to purchase that particular asset. So what they want to say over here is, if I want to employ any asset, I need to compulsorily pay a fixed cost to acquire that particular asset. In the same way, if I'm talking about any funds and the funds are having a fixed return to be paid on that particular availment. For example, if I want to borrow funds from the bank, I need to pay interest to the banks. Suppose I want to take funds and borrow in the form of debentures, I need to pay interest to the debenture holders. And if I talk about the preference shares, then if I take preference shares, I need to pay fixed dividend to the preference shareholders. So in nutshell, what I want to say over here is leverage is employment of these things which are bearing the fixed cost or the fixed return. So as of now, what you need to understand is the definition, which read as leverage is the employment of an asset or funds for which the firm pays a fixed cost or fixed return. This definition is given by J.C. Van Home. So you need to memorize this particular definition initially. Now let's clear out this concept in much more detail. So let's see at this particular figure. The first word that is visible on your screen is business employees. Fine. Now what business is employing? From the one viewpoint, I can say it is going to employ the assets with fixed operating cost. I hope you are very well aware that whenever we are purchasing any kind of asset, we are supposed to pay fixed operating cost in order to avail that particular asset. Let's take an example. I am running a textile industry. Now in this particular industry, in order to manufacture clothes, I need to purchase machinery. Now this machinery is my asset for which I am supposed to incur fixed operating expense. Now in this situation of lockdown, even if my business is shut down, I need to pay or incur the fixed cost. So basically your fixed cost is something that whether there is a production or there is no production, it is mandatory you need to incur that particular expenditure. In this particular case, so what I'm talking about is when a business is employing or using any assets which are having fixed operating cost. Now why it is doing so? In order to increase the earnings of the equity shareholders. What is my optimum objective? You all have studied well in financial management. The main objective, the optimum objective is to increase the earnings of the equity shareholders. So you can say this is one way out. That what I'm doing is I'm planning well in advance. I'm selecting the appropriate asset and I'm purchasing the correct one. So what I'm doing over here, I'm managing my increase in equity shareholders earnings by investing or spending on my fixed assets. Basically this is name of the fixed operating cost. So this particular topic is known as operating leverage. So basically what is operating leverage? Whenever we are acquiring or employing any kind of assets which are bearing fixed operating cost with the motive to increase the earnings of the equity shareholder, then such kind of concept is known as operating leverage. I hope I'm clear over here. So I'm doing nothing. I'm just dividing the definition which we have studied above into two different parts. So first of all, what I have covered, I have covered asset which is bearing fixed cost. So now business need to manage this acquisition of assets in such a way that the fixed cost in minimum, because the lower the fixed cost, higher would be the earnings of equity shareholders. So in this particular concept, in this particular figure, what I have explained you guys is business is employing the asset which is bearing a fixed operating cost. What is my main motive? To increase the earnings of the equity shareholder. Now as a finance manager, what is my role? I need to take an advantage in such a manner that I can acquire this asset at the lowest possible fixed cost, because you all know lower the fixed cost, higher would be my return. As a result of which, this is one way to attain the leverage. So what we are going to do is we are going to find certain relationship between certain terms, like what is the change in EPS, that is earnings per share, if I am having change in my sales volume. So basically we are going to have certain further concepts, but as of now you are just supposed to remember this one-way diagram, under which we have learned that I am employing assets which are having fixed operating costs in order to increase the earnings of my equity shareholder. This concept is known as operating leverage. I hope I am clear with this one side. Okay, now let's move to the second side. In this particular part, business is employing funds with fixed financial cost. Now I hope what is financial cost is clear to you. As let's take an example. I want funding from outside. I am taking a resort to bank, that I am going to bank and asking for a loan. Now whenever I am getting a loan from the bank, at the same time there comes an interest liability, that is I need to pay interest expenses. Suppose if I borrow funds in the form of debentures, I need to pay interest to the debenture holders. And in case if I borrow funds from the preference shareholders, I need to pay a fixed percentage of dividend to my preference shareholders. So in any of this case, what I am getting? I am getting funds, I am getting capital, but against it, what I'm supposed to pay? I'm supposed to pay fixed financial cost. Now again, this concept is talking about that you as a finance manager should employ the funds which are having fixed financial cost in such a manner that there is decrease in the overall financial cost, which leads to increase in the earnings of the equity shareholders. So it may be clear to you friends that my optimum objective is the same, that is to increase the earnings of the equity shareholder, but the paths are different. Here I had talked about controlling my fixed financial cost, and so this concept is known as financial leverage. I hope I'm clear with this. In both the scenario, business is employing either the assets or the funds. If I'm talking about the assets in order to control my fixed operating cost, then this concept is known as operating leverage. If I'm employing funds with fixed financial cost in order to control my fixed financial cost in order to increase the earnings of equity shareholders, then this concept is going to be known as financial leverage. In this particular case, my optimum objective remains the same, that is to increase the earnings of my equity shareholders. But what I'm doing is I am doing financial planning from the viewpoint of acquiring the correct assets with fixed operating cost and using the funds which I'm borrowing from outside in such a manner that my fixed financial cost obligations is at minimum, so that I can create a good amount of earnings for my equity shareholders. So basically friends, when we talk about from the viewpoint of assets with fixed operating cost, the measure is known as operating leverage. When we talk about the funds with fixed financial cost, the measure is known as financial leverage. And now if I compare this entire thing as a business as a whole, that is combination of operating leverage, that is assets with fixed operating cost, with the financial leverage, that is funds with fixed financial cost, is in total, in aggregate, known as combined leverage. So broadly friends, we are going to study in detail three different types of leverage. First is operating leverage, second is financial leverage, and third is going to be combined leverage. Just let me make you clear, till now we have not started with the chapter. We are just discussing and trying to understand the concept of leverage, that what we are studying, what is the basic utility of this particular concept. So leverage is something that is using of assets or fund for which the firm needs to pay fixed cost or fixed return. What is my optimum objective? It is to increase the earnings of the equity shareholders. Either I can go with this part, that is properly planning acquisition of assets with fixed operating cost at minimum, or I can take the path of borrowing funds from outside with minimum fixed financial cost. That is the concept of operating leverage and the concept of financial leverage, which collectively is known as combined leverage. Now, I would just like you to give you a minute, take a view on this particular slide. Well, friends, I hope you are clear with this particular part, that is the definition. So if in case 2 marks question is asked with respect to definition of leverage, you are going to write this particular definition followed by this particular diagram, because this diagram is going to give you the graphical representation of using leverage in order to increase the earnings of the equity shareholders. I hope I'm clear with this. Okay, let's move to the next topic. Now, again, this is something, the heading of which I have given as financial sheet, which is from sales to EPS. Now, before starting this particular slide, I would just like you to draw your attention that till the time you study financial management, this is the basic slide that you need to remember being a finance student. Trust me, friends, if you get stuck in any of the calculation part, this is something which you can say fundamental. Like I generally used to say, as we study concepts of debit and credit in accountancy, in the similar way, this is something which we should know as the finance students. So I can say this is the basic. As a result of which I have given it the heading of financial sheet, which starts from sales, because you all know what is my first thing from where I start earning my revenue. It is my sales. From sales, I am going to take you to EPS, that is earning per share per shareholder. Fine. As a result of which, we are going to start from the macro viewpoint, that is overall aggregate sales, to the individual earning per shareholder. So we are going to study this entire journey by using certain financial terms and concepts. This is the table of financial sheet. Many of you might have studied this before-handedly also in the topics of decision making, maybe, but few of you may not be aware of the same. So I'm going to start it from a scratch. Let's see step by step. The first row in the table read as sales. Now here we are supposed to generally write the amount of the total sales that I had incurred during a particular period. That is the matter of my problem. In this particular case, let's take an example. We are talking about 1 year. So what we are going to do, we are going to write the aggregate sales in order to get the total figure over here. So this is my first point in my financial sheet. So my financial sheet, as the heading says, it is going to start from the sales. From sales, I'm going to deduct variable cost. Now, I hope you all know very well what is variable cost. It is the cost which changes directly with the units of production. Fine. So as and when I increase my production, my cost is going to increase in the same proportion. If I'm decreasing my production, my cost is going to decrease in the same proportion. So basically variable cost, as the name suggests, is the cost which keeps on changing per unit, directly appropriable to the particular product. So basically what I have done is, for example, let's take an example. I am manufacturing a water bottle. Fine. Now the selling price of this water bottle is rupees 20. Let's take an example. There is a plastic bottle, the selling price of which is 20 rupees. So what is my sales revenue over here? 20. Now based on number of units I am going to sell, I'm going to multiply 20 multiply by number of units sold. So I'm going to get my total sales figure. Now, in this particular water bottle, there are many expenses that I'm incurring. Let's say I'm incurring 15 rupees as my variable cost. That is, you can say the cost of direct raw material, that is the plastic I'm using, direct laborer, that is the person who is actually making that particular bottle, that is our variable cost, that is directly related to our production. So basically 15 rupees is my variable cost. So what I'm going to do is I'm going to deduct variable cost out of my sales revenue. In short, I am getting the answer which is known as contribution per unit. Now, what is contribution? When we say in general business terms that what is the margin in your particular product, this margin is nothing. It is your contribution. That is the amount that you are earning by selling a particular product. It is your margin. In financial terms, we are going to name it as contribution. So in our example, the plastic bottle, if I take the example of 1 unit of plastic bottle, the selling price of that bottle was rupees 20, while the variable cost for that bottle is 15 rupees. As a result of which, what is my contribution? 20 minus 15, which is coming to 5 rupees. So I can say I am earning a contribution of rupees 5 by selling one bottle. Now it depends on the total number of units you have sold during a particular year. For example, I have sold 1 lakh units, and my total contribution is going to be 5 rupees per bottle multiplied by 1 lakh units, which is going to come at 5 lakh. So basically what you need to remember as of now is we are at the first phase of our financial sheet where we had learned, first of all, we are going to start with the sales. From that, we are going to deduct the variable cost. Now, I hope you are clear like what is variable cost. So what I'm going to get as a result, I'm going to get contribution. Now, from the contribution, I'm going to deduct my fixed cost. Now, just recollect the previous slide we have studied, under which we had taken due care of that when the business is employing asset which is having fixed operating cost in order to increase the earnings of the equity shareholder. So this particular part I have specifically bold it so that we can connect it with the concept of leverage also. As of now, I am not discussing that. We are going to discussing after discussing this entire table. Now, for now, you need to remember that from contribution, what I'm going to deduct, I'm going to deduct my fixed expenses. That is my fixed cost. Now, fixed cost is something, no matter I'm selling 1 unit of bottle or I'm selling 1 lakh units of bottle, it is going to remain constant. As a result of which the expenses which is constant are going to be demarcated as your fixed cost. For example, my factory is on a rent. Fine. Now, though I'm manufacturing and selling 1 unit or I'm selling 1 lakh units, the rent expense is going to remain constant. As a result of which, what I want to write over here, I'm going to deduct fixed cost. So contribution was the margin that I'm earning on my production minus I have sold fixed cost. I have deducted fixed cost. So what I'm getting as a resultant figure, I'm getting EBIT, which stands for earnings before interest and tax. As it is clear to you, till now we have not deducted any expenses for interest or taxation. As a result of which, this amount that you are getting by deducting fixed cost from the contribution is known as EBIT, it is earnings before interest and tax. From that, we are going to deduct interest. Now again, I have bold this particular part because if you recollect the previous slide, we have done the second part under which we had learned that when a business is employing any funds which are having fixed financial cost. What is financial cost? It is nothing. It is your interest. As a result of it, this is again going to be relevant to your leverage topic. But as of now, I'm skipping that part. What we need to remember in this particular table that after EBIT, I'm going to deduct my interest expenses. So basically, what is my interest expenses? If I've borrowed funds from outside, like say for example, I have taken a loan from bank, then I need to pay interest to that particular bank. As a result of which, whatsoever is my expense as an interest, I'm going to deduct it over here. So what we have done, EBIT minus interest. So now what I'm going to get, EBIT में से I निकल गया, so now we are left with EBT, which stands for earnings before tax. Now we are going to deduct the appropriate tax rate. So for example, if my company is liable to pay 50% tax rate, what I'm going to do, I'm going to deduct 50% of EBT. So let's take an example. If my EBT, that is earnings before tax, is 1 lakh and my tax rate is 50%. So what I'm going to do, 1 lakh multiplied by 50% is coming to 50,000 rupees. So the percentage of taxation is basically going to be applied on EBT, that is earnings before tax. So this you need to remember, that on what the percentage of taxation is going to be applied on EBT, that is earnings before tax. So till now I hope you are clear what we have done. EBT minus taxation. So now I am getting EAT, that is earnings after tax. So what we have done, from earnings before tax we have deducted taxation, as a result of which we are getting earnings after tax. Now this is, you can say, similar to your profit after tax. Fine. After earning profit, now what we are doing, we are going to pay first of all to our preference shareholders. So now what I'm going to do, I am going to pay dividend to my preference shareholders. So what I'm doing over here, earnings after tax minus preference dividend. So now finally what I'm getting earnings which is available to equity shareholders. I hope I'm clear. So from this table, you may get to know that we had started with the first point of earning, that is our sales. Till that we have reached to the equity shareholders, who are the real owner of the business. So from my first source of earning, I had deducted all my expenses. I had paid all my obligations, like in the case of fixed costs, to the outsiders and creditors in the form of interest, tax liability to the government, and finally dividend to the preference shareholders. So now the resultant amount that I have left with is known as earnings, which is available for equity shareholders. And finally, in the table below, I have written earnings available for equity shareholders divided by number of equity shares outstanding. For example, let's say earnings available for equity shareholders is 50,000 rupees and number of equity shares outstanding are 5,000. So what I'm going to do, 50,000 divided by 5,000. So my answer is going to come to rupees 10. What is rupees 10? It is earnings per share. So if I want to know what I as a company has earned per share, the answer is coming to rupees 10. So I can say I am earning rupees 10 per share, which is nothing, which is known as EPS. I hope I am clear with this particular financial sheet. I would just request you to take a quick overview on this particular point. Then we are going to link the same table with the leverage concepts. Well, I hope you are clear with this particular financial sheet. So friends, first of all, I would like to request you that before we start with the practical sums on this topic in our later lectures, please learn this particular financial sheet, because if you are clear with this particular sheet in your mind, then it will be much more easier for us to imply the formula and to get the answers for the leverage. Now, let's just recollect the previous slide that we had discussed. Under this slide, we had told that when I'm talking about operating leverage, I'm talking about the fixed cost. And whenever I'm talking about financial leverage, I'm talking about the fixed financial cost. That is nothing, that is our interest. So here we need to understand two important words. One is fixed cost and second is interest. Now let's recollect it with this particular table. Now, first of all, where is my fixed cost? Over here. So now the first concept that we studied was leverage is a measure which is going to basically tell you the relation which is with respect to the fixed cost. Fine. So my operating leverage formula is contribution divided by EBIT. Now, in order to remember this formula, you are just supposed to remember this particular order. Where is your fixed cost? Over here. So the formula is simple. Fixed amount of earnings before fixed cost and amount of earnings after fixed cost. That is contribution as your numerator and EBIT as your denominator. Why? Because we know what is operating leverage. It is the proper use of your fixed cost assets in order to increase the earnings of the equity shareholders. So how well I have managed my fixed expenses, how well I have controlled my fixed expenses, the measure of the same will be depicted by operating leverage. So again, let me tell you guys, leverage is the indication of the relationship, fine, between the financial terms. So as of now, I hope you are clear with what is operating leverage. The formula for the same is contribution divided by EBIT, that is earnings before interest and tax, that is amount before fixed cost and amount after fixed cost. Let's take the second formula. In second formula, I have written financial leverage. Now, as we have discussed, when we talk about financial leverage, it is related to interest. So again, where is interest? Over here. So again, the concept of formula remains the same. It is earnings before interest and tax and earnings before tax. That is before interest amount and after interest amount. So the numerator is EBIT and denominator is EBT. Just take a quick view, friends, what I have written over here. First is operating leverage, under which I have told you operating leverage is related to fixed cost, as a result of which we have taken the amount before fixed cost and after fixed cost, which is contribution and EBIT. So the formula is here, contribution divided by EBIT. Second is financial leverage. As we all know, financial leverage talks about the funds which are borrowed from outside. What is the financial cost? It is interest. So we need to keep in center interest. Numerator will be amount before interest and denominator will be amount after interest. That is EBIT divided by EBT. So here it is EBIT divided by EBT. Earnings before interest and tax divided by earnings before tax. So this is a much easier way to remember the formula if you are clear with the order of the financial sheet. So I have told you guys that please learn this particular order properly. This is going to be useful in many of the applications. It is not limited only to this particular chapter, but when you are going to study decision making concepts, the same sheet is going to be useful to you guys. Fine. And at the end, I have told you in the previous slide that these are the two different aspects. One is with related to my fixed cost, which I have named as operating leverage. One is being related to my fixed financial cost, which I have named as financial leverage. But if I want to study the overall impact, I need to study combined leverage. And combined leverage, as the name suggests, is nothing is the combination of two things. So here it is. In this table box, I have stated combined leverage is equal to operating leverage multiplied by financial leverage. So in crux, if I'm going to multiply the effect of both the leverages, that is from the viewpoint of fixed cost and from the viewpoint of fixed financial cost, that is interest, I'm going to get the combined leverage. So here it is operating leverage multiplied by financial leverage. Now what I have done over here, I have just replaced these words with its formula. Like what is the formula of operating leverage? It is contribution divided by EBIT. What is the formula of financial leverage? It is EBIT divided by EBT. So solving this particular equation, your EBIT is going to get cancelled, as a result of which the final formula is contribution divided by EBT. So here is your contribution, fine, and here is your EBT. So combined leverage is covering both the things, fixed cost as well as the effect of the interest. So this is shortly, I can say, the concept of leverage, under which if I want to say, I can say this is your entire chapter. If you know the formulas, if you know the implementation of formula, you are done perfectly. But this is still, I'm telling, this is just the beginning. Today we have just cleared out what are the concepts of this leverage. Now in detail we are going to take each one of them in each of our upcoming lectures, when I'll be explaining you what is operating leverage, what is the meaning of operating leverage, what is the formula, what is its effect, and what are the advantages of the same. Same we are going to do for financial leverage and combined leverage. So I can say it is just a trailer, picture is yet to come. But it is necessary for you that if you want to perform well in the picture, you need to be well equipped with this particular trailer. So I hope you are clear with this entire thing. I would just like you to request that please take a quick view on the formulas that I have written on the right side of the screen, because post this slide we are having test your knowledge series and questions are going to be based on this particular formulas. So I'm giving you a minute, take a quick view on the formulas and learn that. Well, I hope you are ready with all the three formulas. Operating leverage means contribution divided by EBIT. That is amount before fixed cost and amount after fixed cost. Financial leverage means EBIT divided by EBT. That is amount before interest and amount after interest. And combined leverage is nothing. It is the multiplication of operating leverage and the financial leverage. So let's start the test your knowledge series. I'll be giving you 30 seconds for MCQ. Mark the correct answers. At the end of the MCQs, we are going to discuss the correct options. So your time starts now. Well, I hope you are ready with the correct answers. So let's check each one of them. The first question was calculate operating leverage if contribution is equal to rupees 5,000 and EBIT is rupees 1,000. As we have studied, operating leverage is related to fixed cost. So the formula was contribution divided by EBIT. As a result of which, here we are going to talk about 5,000 divided by 1,000. So our answer is going to be 5. So the correct option is option A, 5. Fine. Second question was calculate financial leverage if earnings before tax is rupees 1,000 and earnings before interest and tax is rupees 2,000. We know financial leverage is basically related to financial cost, focusing majorly on the interest. So the amount before interest is going to be your numerator and amount after interest is going to be your denominator. So the formula is EBIT divided by EBT. So it is going to be 2,000 before interest divided by 1,000 after interest. So it is going to come to 2. So the correct answer is option A again, 2. Fine. And the last one is calculate the combined leverage if your operating leverage is 2 and financial leverage is 3. As I have discussed, combined leverage is the overall criteria, as a result of which, under which we are going to consider the multiplier effect of both the kind of leverages. So the formula of combined leverage is operating leverage multiplied by financial leverage. So it is going to be 2 multiplied by 3 is equal to 6. So the correct answer is option C, 6. I hope you have got your answers correctly. I would just like to request you all once again, please go through this lecture, especially the formula part and the financial sheet part, because this is something which is going to be of much more useful in your future upcoming lectures, because each and every practical sums will be done correctly if you know this perfectly, as a result of which it is important for all of you to learn this particular sheet in a correct manner. With this, I, CA Pujan Kapadia, thank you all for your patient listening and hope to see you soon in my upcoming lecture. Thank you, friends.